The Money Show.
Personal Finance with Warren Ingram.
The personal finance feature. Warren Ingram, of course, is a certified financial planner at Galileo Capital. He's happy to take your calls on 011 883 0702 and 0214460567. You might also just want to send a voice note on 072 702 1702. Warren, good evening. Tonight we're talking about investment fees. We spent a lot of time talking about what works, what doesn't, what's going to grow and what won't. We spend very little time talking about investment fees.
And you're right, Stephen. So I'm glad we're chatting about it tonight because it's one of those things that can be a little contentious. The temptation is to say to people, try and find an investment that costs you nothing, and if there's no fee, then you're going to get all the benefit. But unfortunately, that's not really true. Sometimes the fees that you pay are actually for good value, and so I guess the starting point for something like this is we need to understand what fees are, and then we need to understand what we're paying for, and then figure out, are we getting value for these fees? And if not, then maybe it's time to make a change.
Okay, I mean, one of the reasons we don't think about them, they're a bit like bank fees, is you don't always see them. You have to go looking for them.
Yeah, and for most investments nowadays, they're expressed as a percentage. So, you start out and someone says to you, your investment's going to cost you 2%. And in the early days of your investment career, if you're starting out with 5,000 Rand a month, then you go, well, okay, it doesn't sound like a lot of money if you go and work out that percentage. And so you go with it. And, month after month, you pay your fees. And, over time, the capital starts to build up. And it probably takes a solid, 10 or 15 years before you've got, really sizable amount of money. And then perhaps for the first time, you start to work out what these percentages actually are. And by then you've been paying, potentially very high fees for a long period of time. So because it's a percentage, and we start, most of us, and unfortunately, we don't really get born rich, do we? Very few of us. So we start out with a small amount of money, and a small percentage of a small amount of money is not a heck of a lot. So it just doesn't draw our attention.
Okay. Is cheap good? I mean, cheap can't always be better. Where's too expensive? I mean, where do you start with this conversation?
Yeah, it's one of those things, when I started looking at this, I was so angry with the industry because fees were so incredibly high. And it just felt to me that, when you bought a retirement annuity from an insurance company, you were paying out 25% of your investment as fees, and it was all loaded up front, and it was just really bad. So the investment industry unfortunately has quite a history going back of being very expensive and not very clear and transparent as to how they charge. And so there've been many new platforms that have been built over time, starting with unit trusts and then to exchange traded funds, and then they've kind of got blurred and blended. And we see so many new kinds of platforms now, where sometimes the fees seem quite low. You might not pay an annual fee, but you pay a fee every time you buy or sell. And so I think the complexity is there. But one of the things I would say is that you should be very clear as to what you're paying and why, because sometimes an investment that seems to cost very little, you might sacrifice an enormous amount in another way. So for example, my favorite is someone will say, this is a guaranteed product that you can buy, and it's going to cost you no fees. There are no fees. All you need to do is invest this money and leave it for 5 years. And after 5 years, if there's been bad markets, you get your money back. And if they're good markets, you're going to get some kind of a growth, but there are no costs. Well, that's garbage. There are no financial services companies around that are solid charities that just do this for the good of mankind. They do it because they make money. So there is always a fee. And so if someone says to you, this is free, I would be paying real attention and be incredibly careful, because that might end up being the most expensive investment you ever own.
Okay, some funds, it can be 0.5%, right? It's 0.5%. Some, these ones I presume will be actively managed, will charge 2.5%. What impact does that have to my savings over the longer term?
Yeah, so this is I think maybe the crux of where the industry is right now, the investment industry, where you've got, the index trackers and exchange traded fund companies have come in with very low fees, and they've created sort of a crisis for the actively managed part of the industry. So those are the fund managers that are aiming to do better than the stock market growth. And what's happening is that they've had a long history of charging sometimes 3.5% up to 5% if they charge performance fees. And on the other side of the equation, they've had exchange traded fund providers charging a tenth of that. So one company charging 5% and the other one charging 0.5%. And that's a massive difference and really worth paying attention to. So the active managers have come down very significantly in fees. And so now you find that gap's a bit smaller. And then the question is, why do we pay active managers at all if they are expensive? And I guess we've probably all just lived through a very good example. Is you look at something like SpaceX, which is by all accounts, I don't think anyone would value it and say, gee, this is a cheap company. It listed as an expensive business and became much more expensive for a couple of days, and then is given most of that back again. And so you're actually paying a fund manager there to apply their minds and to look at a business like that and try and come up with a valuation, and then decide this value is worthwhile. In other words, it's a price I should pay, or actually this is incredibly expensive and I shouldn't take clients' money and put it in this because they're likely to either make no money or lose over time. So active managers get paid now to apply their minds either to try and give you a bit more growth in the stock market, or very often nowadays, the other way around. They actually try and take some of the risk out of the stock market by avoiding expensive companies and maybe loading up on those that are a bit cheaper. And, the tech sector in America is keeping a lot of people awake at night because it's so expensive. So I think that we're probably getting to a point where the active managers are becoming probably a little bit more fair in their fees. I think they've got a way to go. They can get a bit cheaper, but on the other side of the coin, you've got the index trackers that are well priced, and for a lot of people would be a very good default option. You just don't need to think more than just buy the index in most situations.
Is it one of those things where you should get what you pay for? If I pay more, I should get a better return. I mean, this is a stock market we're talking about, so it might not always work out like that.
Yeah, I think it's true. I think you're paying sometimes for peace of mind. So let's say you're paying an active manager. What you're paying for, if they're good at their job, is you're paying them to make the least amount of mistakes possible. Unfortunately, they're going to make mistakes, and what you're hoping is that their mistakes are not that expensive and their successes are very good. And so you are paying, if you are going to pay a premium, you're paying for a good team, a good process, and a sleep at night factor. And I think that has value. And I know, if there are fund managers listening to this, they're going to probably go, but hang on, that guy's a financial planner. What about him? And I would say the same thing. If you're going to pay a financial planner a fee, then you need to know that you're getting well served, that the investments that you've got have been designed for you and are appropriate for you, and that you're being served and coached over a long period of time. And if you're not getting that as a service, then you shouldn't be paying the fee. So it's important to know that if you are paying fees, that you are getting value for it. Otherwise, you should be looking for better cost alternatives.
How does it change over time? I mean, 1% is not a lot, but over time, I presume it is.
Yeah, I think, I'll kind of do a little example. So let's just say we've got 100,000 Rand and we invest that money and we work that out as a percentage of a fee, and the fee is 1%. So 1% of 100,000, it's not a big number. It's 1,000 Rand a year. And if you've got 100,000 Rand, you're probably not really losing sleep on paying the $1,000 a year. But the thing to understand about percentages is they're charged every day of every month of every year. So you're not just paying 1,000 Rand for the year once off, you're paying it again next year. And so if your investment continues to grow, then you're potentially paying a bigger fee. Equally, if your investment goes down and the stock market's down, you're paying a percentage still. And so understanding that fees compound against you just in the same way that you get compound growth on good returns from your investments, fees are compounding against you. So it is really something, we would encourage people to pay attention to. You can't be serious about your money and not know what you're paying. And I think that 1% is important because there are a lot of investments out there nowadays where your fees are, kind of around 3% a year when you add them all up, and all the layers that you have to pay. But is it possible to get a similar or maybe equally good range of investments, and when you add everything together, you're only paying 2% a year? And if you are, that can start to make real difference with money over time.
Okay, so if we break down the fees then, and I mean, they occur in layers, what layers do we tend to look at?
So in most instances nowadays, you're going to pay a fund management cost, and the industry loves jargon. So unfortunately, we've got to like immerse ourselves in their horrible jargon. But the fund manager fee is often disclosed as something called the total investment charge. So it should be the entirety of the fund manager's cost. So that's the annual management fee and the transaction charges when they're buying and selling your investments, etc. And then the second fee you're likely to pay, especially if you've got something like a living annuity or a retirement annuity as well, then you're probably going to pay what they call a platform fee or a LISP fee. So that's for administration. That's for being the custodian of your investments, making sure that they're secure, and providing all your tax reporting and making SARS happy on your behalf. And then you've got potentially a financial planning fee as well. So typically you're going to have all of those charged together, and that's where you need to figure out what are you paying, and often on your statement you should be able to see something called effective annual cost. So that's the total of the total. It's all the things put together and shown on one number.
Okay, so that's the number to look for, is the EAC, the effective annual cost.
Yeah, but I do think you want to focus on each of the individual parts as well to see, if you, let's say, I mean, very often I'm still shocked to see an EAC of 5%, and when you see something like that, you want to understand, where am I paying these fees? Where is the leakage in something like this? If it's 3% or lower, you're starting to get to kind of what the market should be charging. But if you're at 5%, you need to understand, am I paying it because of the fund manager, or is it the platform, or is it the financial planner? Who's actually charging me the highest portion, and who's out of line in this whole thing?
Okay. So what would a fair fee then be? I mean, you'd have a fund manager, administration, an advisor. What kind of numbers would you be looking at?
So I mean, I'm going to have to sit on the fence a little bit and give everybody a range because it's going to depend. So for your fund management costs, so that total investment charge, you should be looking in the region of 0.5% at the lowest end, up to about 2% a year at the high end. And just to understand that, the lower end is often because you're either investing very large sums of money or because you've chosen index trackers or exchange traded funds. At the higher end, that means either you're investing a small amount of money or you've chosen an actively managed fund. So 0.5 to 2% a year on the fund manager. And then for the platform or the administration fee, if you're investing a large amount, you could get that fee as low as 0.2% a year. Most of the time when we start out, we're paying around 0.5% a year for administration. And then if you're using an advisor, that fee will generally range from about 0.5 to 1% a year. And again, that will be based on the size of the investments that you've got, the complexity, etc. So you are in a range, and at the very lowest end, you're probably in for around about 1.2% a year when you look at that EAC, up to around 3.5% as a maximum. And as I say, if you're paying more than that, if you're at 5% as an EAC, you need to be asking some serious questions, because I just don't think that's really justified in this day and age.
Okay, we've got questions for Warren. One comes from Rian. Rian's saying, "Hi, I'm 58 years old. I've just sold a small rental property after paying off the remaining bond and the agent's commission. I'm left with 900,000 Rand. I have no debt. I still work. I already have a retirement annuity and a pension fund through my employer. What should I do with the money? I've never invested outside South Africa. I don't really understand how offshore investing works and whether it's risky. Does it make sense to take some of it offshore at my age? All right, Rian, we'll have an answer for you in a moment.
The Money Show.
Personal Finance with Warren Ingram.
And Warren Ingram, of course, is the financial advisor and co-founder at Galileo Capital. We're talking about the costs of your investments. And we have a question from Rian. I am 58. I've sold a property. I'm left with 900,000 Rand. I have no debt. I have an RA and a pension fund. What should I do with the money? Should I take it offshore? Warren, quite an interesting question from Rian, I thought.
Yeah, and I like I'm interested in the fact that Rian says he's 58, and at his age, should he be investing money offshore? Well, Rian, if you look at the actuarial tables, they're going to say that males in South Africa live probably pretty close to kind of age 85. So you've still got quite a long investment career ahead of you, and even if you're getting closer to retirement, you should be looking at this as maybe a 30-year question. And in that case, I always think it makes sense to have some of your investments exposed to international markets. So you certainly should look at the global markets for a portion of your money, and maybe taking 25% of your investments and allocating overseas over time makes sense. So if 900,000 Rand is a big portion of your kind of net wealth, then be careful. But if it's not, and it's below the 25%, certainly something you should consider. I do like the idea of that if you think it's risky, maybe you do this slowly and you do it in batches over a kind of a 1 year period where you do it 3 months. I was going to say 300,000 now and 300,000 in 6 months' time, and then the last 300,000 at the end of a year. So you can spread it out, but certainly you should be looking at offshore investments as part of your portfolio. And then I have to ask, because it's not, you didn't mention it, but if you don't have a tax-free savings account, then you got to do that as well. And you can always buy a global investment inside your tax-free.
Yeah, that would make sense. And if just to diversify where you've got your money would be the main thing, wouldn't it?
Did you just say diversify, Steve?
I did.
I just want to check.
I just wanted to trigger you and see what would happen.
I'm glad you're drinking my Kool-Aid. Yes, please diversify. Diversify is the way to go.
Okay. All right. So we've been looking through investment fees this evening. Tomorrow when I sit down and look at all of this stuff, or the day after if I'm listening on the podcast, what should I actually be doing?
I think you need to figure out exactly what your effective annual charge is. That's the total of all the fees that you're paying. It's information is always powerful in something like this. So, if you get that, it's not difficult to get. You should be able to see it on your statement. If you use an advisor, they need to be able to send you that in written form. And if you don't use an advisor, go onto the website of the product provider and have a look or contact them. But it's something they're obliged to give you in writing. It's not something that, you're not asking for something strange. So you should demand it if they haven't given it to you. And then look at, each of your investments. So if you've got a few investments, understand what you're paying on those effective annual charges. And just get a good idea of what those are. And I think to give you a range, if you are using an advisor and you have got a platform and then some unit trusts or exchange traded funds, and you're in that region of, let's say, 2 to 3% a year as a total across all of those, then you're probably doing well. If you're below that, you might be benefiting from some sizable investments. And if you're above that, then it's time to start asking some questions. As I said, maybe look at how those fees are made up. So are you paying high fund management fees or high advice fees or high platform fees? But just figure it out. And if you are overpaying, ask some questions, demand some changes to get those fees down. And if you can drop that fee a little bit and get it into that 2 to 3% range, that little bit of a change, can make a dramatic difference to your money over a 10 and 20-year period.
Well, this is the point. We've got 20 seconds, Warren, but this is the point. Is it's really worth looking at the numbers because of the difference it makes over such a long period.
Yeah, 0.25 sounds like nothing as a percentage, but it makes an enormous difference over 20 years. So please do it. Do yourself a favor.
Warren Ingram, thanks so much. Really do appreciate it with personal finance this evening. The certified financial planner and co-founder at Galileo Capital with personal finance on The Money Show this evening.